This module discusses the accounting information system. Specifically, this module discusses the concepts and standards that support the financial statements. As with almost everything, we need standards. We use them to understand information, put things in context, compare things, etc. Standards differ from rules. Rules are regulations that govern conduct for a particular activity. Standards are a level of quality. They are based on an idea or a thing used as a measure, norm, or model in comparative evaluations. Accounting standards ensure the financial statements for multiple companies are comparable. This makes the financial statements credible and allows for more economic decisions based on accurate and consistent information. Standards begin by deciding what values are desired for reporting, and we'll get to that shortly. We'll start first with the things you probably know. The SEC is the Securities and Exchange Commission. The SEC is a U.S. government agency that oversees U.S. financial markets. FASB is the Financial Accounting Standards Board. They're the primary accounting standard-setting body in the U.S., and in order to remove bias or influence, these board positions are full-time and fully paid. This board issues pronouncements that we call FASBs, and they are the standards we have to follow as a minimum of information on the financial statements. And as an FYI, there's a GASB for government standards. The main standards we refer to are GAAP, GAAP, Generally Accepted Accounting Principles. The values of accounting standards are defined here. On a technical level, both the SEC and FASB have standards that we call GAAP, but since the SEC requires public companies to follow GAAP, we primarily refer to GAAP as the standard set by FASB. Of course, the SEC sets the rules for U.S. companies, so it makes sense there's parallels for companies outside of the U.S. The IASB is the International Accounting Standards Board. Most of the IASB standards match with FASB's. However, there are some differences, and there are groups of individuals working on congruence. Our ideologies differ on some issues, so they will never be totally aligned, but they are very similar. An audit results in an audit report where the auditor gives their opinion that the financial statements are in accordance with GAAP. The PCAOB, Public Company Accounting Oversight Board, determines auditing standards and reviews the performance of auditing firms. This developed as a result of the audit corruption years ago. As mentioned earlier, standards start with values. They are the minimum reporting requirement, so companies are always free to provide additional information, as long as it also follows the standards. The purpose is to provide information that is useful to the stakeholders who use the information, the shareholders, creditors, etc. It is important if it is useful when making a decision. The two fundamental qualitative characteristics are relevance and reliability. Something is relevant if the information has the ability to make a difference in a decision scenario. Information also has to be reliable. It has to be neutral and not biased. Remember, this is about having useful information to make a decision. If the information is provided ahead of time, it provides predictive value. It provides feedback value if it confirms or corrects prior expectations. The other fundamental characteristic is reliability. Does it faithfully show what financially happened? It may be obvious, but from a legal perspective, due care must be taken to ensure it is accurate or free from error. While the company wants its financial statements to show in the best light, it must not be biased to lead users towards a specific decision. And again, while a company wants to show it in the best light, it must also show the things that can be perceived as negative. So the financial information must be complete, even if it shows things that management did poorly. The fundamental characteristics are enhanced with these characteristics. We've already mentioned following standards allows companies to be compared. Now, of course, information has to be timely as well. Telling you a company's going to have a stock split after it happens doesn't help you make a decision to purchase the stock. Telling you ahead of time gives you predictive value that we mentioned earlier. Also earlier, I mentioned that information has to be free from error. It also has to be verifiable, as in, given the information provided, someone else would come to the same conclusion. And while a company wants to show itself in its best light, and it's complete when it shows all information, positive and negative, it must also report the information in a manner that can be understood by the average investor. Now, I just mentioned the characteristics of information, but sometimes the cost is too much. For example, stores have RFID tags on some inventory, so an alarm buzzes if someone leaves the store without paying for that item. However, those tags are not on everything, because it doesn't make sense to pay $1 a tag for an item that costs 50 cents. So that is the cost-benefit rule. If the cost to report something costs more than the value derived, it doesn't need to be followed. So another example, while raw materials inventory can be reported for each item in inventory, the cost to do so isn't worth it. So raw materials inventory can be reported in its entirety. Now, materiality, it's relative, it's company specific. An item is material when its size makes it likely to influence the decision of an investor or creditor. For example, you might not care if Google's financial statements are off by $10,000, but you might think it's a problem for a one-person PI firm. So $10,000 is not material for Google, but it is for that sole proprietor. We'll talk more about these as the modules move along, but here's a quick overview. When are revenues, expenses, and assets recognized? Well, we recognize revenue when it's earned, and not necessarily when cash changes hands. So if I do the work and you owe me the money, I have earned it. That's when I'm going to recognize income. Now, what determines the value that we're going to report? For example, how do we value inventory if the cost of the inventory changes daily? How would a gas station report its inventory since the purchase price changes daily? And in another module, we talked about the classified balance sheet. But how do we present other information? Is there a method to listing items on the income statement? And what information needs to be disclosed? We can't put everything on the financial statements, or there will be pages long and we will get lost before understanding the income or the expenses. And so we have footnotes. The economic entity assumption is that every economic entity can be separately identified and accounted for. And economic events can be identified with a particular unit of accountability. Think of this for the home business, where someone's Etsy revenue should be separate from the individual's other cash. The reporting from this business should be separate from a financial reporting purpose, even though the business is reported on the individual's income tax return. The monetary unit assumption, as it applies to U.S. corporations, is that U.S. dollars are stable in the long run. For example, the balance sheet of a company shows land at a value of $200,000, even though one parcel was bought 5 years ago for $70,000 and another parcel was purchased this year for $130,000. If an asset cannot be expressed as a dollar amount, it cannot be entered into the general ledger account. For example, the management team of a very successful corporation may be the corporation's most valuable asset, and the company's the beneficiary of some life insurance policies on those individuals. However, the accountant is not able to objectively convert those talented people into US dollars. Hence, the management team will not be included in the reported amounts on the balance sheet. The periodicity assumption is simple, and most people understand it, but it really needs to be stated. Business activities are divided into artificial time periods. They have fiscal years that correspond to the organization's business cycle. So, while most businesses start on January 1st, they can actually start anytime. For example, there are some that start on July 1st, and that is the date that's used for reporting. There are also a few with some really odd time frames where the date changes. For example, they follow a 52-week, and 53-week year, so the last day of their year is always on a Saturday. The going concern assumption assumes the business will remain in operation for the foreseeable future. The principle purports that every decision in a company is taken with the objective in mind of running the business rather than liquidating it. Going concern is an important part of the generally accepted accounting principles. The going concern principle allows a business to defer some of their prepaid expenses to future accounting periods rather than recognizing them all at once. It also allows debt to be categorized as current and non-current. If a company was not going to be around in the long-term future, all of the debt would have to be current debt. So this is a simple but very important assumption. GAAP generally uses one of two measurement principles, the cost principle or the fair value principle. A historic cost requires assets to be recorded at original cost because that amount is verifiable. It's used on almost all assets. Because current assets generally don't change in value quickly over a year, it generally applies to all but stock or investment items. We generally use it when we're referring to property, plant, and equipment. The amount in the financial statements is what we call the capitalized cost. These additional costs can be delivery, assembly, etc. Once the asset is used, the costs to maintain the asset are no longer capitalized. They are expensed. Now, the fair value principle requires that assets and liabilities should be reported at fair value. That's the price received to sell an asset or settle a liability. Fair value accounting uses current market values as the basis for recognizing certain assets and liabilities. Fair value is the estimated price at which an asset can be sold or liability settled in an orderly transaction to a third party under current market conditions. This definition includes the following concepts. It uses the prices associated with actual market transactions for similar or identical assets and liabilities to derive a fair value. For example, the prices of securities held can be obtained from a national exchange on which these securities are routinely bought or sold. The full disclosure principle requires that all circumstances and events that would make a difference to financial statement users be disclosed. For example, if a customer fell on an unplowed parking lot and was suing the organization, that information would have to be disclosed if it happened during the reporting year, and either the amount could be estimated or the organization was likely to lose the lawsuit. Of course, a lawsuit, if it's immaterial, doesn't have to be reported. Likewise, if the cost of reporting is more than the benefit, it doesn't need to be reported. That completes the module on financial reporting and standards and is part of the accounting information system. Please reach out and let me know if you have any questions.